So what is the difference between a gambler and a professional trader? Well, the answer to that lies in a professional strategy. Now, gamblers probably have strategies too. When a gambler goes to the casino, they have maybe an approach that they may follow. For example, if I'm somebody that's a gambler that goes to the casino to play roulette, I know that I have 38 options to pick from. And I could always say, I'm only going to pick even numbers. That could be a strategy. Or I could say I pick the birthdays of my loved ones. That could be a strategy. Or I could say I'm only going to pick prime numbers. That could be a strategy. A strategy is simply an approach. It's a targeted plan. So we can't say a strategy is enough to be a profitable, consistent, professional trader. That's quite misleading, because what does everybody say when you get into the industry? Buy some courses and learn a strategy. Learn concepts to therefore have a strategy. But if I told you go to the casino and have your strategy being you're only going to pick even numbers, well, I would say that's not really a strategy. A strategy has to be more encompassing. And for that, you need a multi-step plan to make sure you are building a strategy in a correct way. So before we get into what we should be doing and how you can avoid yourself being a gambler, we need to understand exactly how the casino operates, because a lot of people see the casino and the financial markets as a mirror, meaning to say the house always wins. As you know, on a long-term horizon, the casino always wins. And why do they always win? It's because they have a very, very small edge. That edge that goes unnoticed, but over time, over thousands and thousands of people, it becomes a guaranteed business model that makes millions of dollars for these casinos. And how does it work? Let's use the example of a roulette wheel. So in a roulette wheel, there are 38 options, and you see the number 1 to 36. And you know, each one is alternating red and black. You think, well, this is 50-50. But what they creep in is the two green numbers. Those two green numbers that you very easily disregard, that is the edge. That's what skews everything for the casino to be in their favor. Now it's no longer 18 red out of 36. Now it is 18 red out of 38 and 18 black out of 38. So that 50-50 becomes 47.3, 47.3, and then about 5.3% for the casino. So that small edge, those two green options that the casino adds into the roulette wheel, throws everything off. And therefore, the losing participant is always the player, not the house. The house always wins. Now, another fallacy in the casino from a gambler's perspective is that past events predict future events. And that's actually what beginner traders do too. In the casino, you might think the last 5 plays, the ball landed in red. So therefore, you choose red because you may think if it happened 5 times in a row, my chances are better for the 6th time. So the gambler notices that pattern and says, I'm going to go on red. Or it might be a case of the gambler might have had 3 wins in a row and they might think, I'm on a hot streak, let me go again. Failing to realize that there is no correlation between past events and right now. In the casino, in the markets, each moment is unique. Each moment has its own statistical and probabilistic scenarios. So therefore, if we're using past events to reinforce current scenarios, that is the gambler's fallacy. So in the market, what could that be? It could be a case of, I noticed price has reacted off this support level, 1, 2, 3, 4, 5. So therefore, I should expect the market to react here, and therefore you buy because of this support level. That is the same as the gambler's fallacy. So therefore, the way I like to think of it is the market does not have a memory. If the market goes up or down, if the ball lands on red or black, it doesn't remember the last 5 plays. Each individual moment in the market is unique and it has its own probability. And therefore, what we need to do is be like the casino, where we have a statistical edge in our favor, that we know that over time, over a large sample size, the probability will converge towards the expected edge. And that's all it is. So now that we've understood how we want to be like the casino as traders as opposed to like gamblers, and therefore the mindset and approach has to be different. We have to have a statistical proven edge. We need probability and time to play out. And we need to be looking at the market, our edge, from a perspective of causation, not correlation. So once we have these 3 things solidified, we are well along the way to be different from a gambler and actually like a professional trader. So step number 1 is when you're in your curation phase, when you're in your strategy building phase, you have to be very intentional. And that doesn't mean you go and bounce from strategy to strategy, from mentor to mentor, searching, hunting and praying for this holy grail, this specific confluence, this specific way of looking at the market that will break everything else. That's the lazy person's approach. That person is looking for a shortcut so that they don't have to put in the hard work, which is very obvious and clear. Concepts and confluences matter, but it's not the be all and end all. The only filtration criteria you should have for your confluence is it correlation or is it causation? If it's Fibonacci, that's a correlation. That's just a bell curve of where reversals happen. It's a statistical edge, not the causation of the market movements. Support level, double tops, this is a correlation. These things we should avoid. indicators, lagging, correlation, that doesn't drive the market. Causation is what we need to use for our confluences. Correlation, we disregard them. So once you start to learn confluences and approaches and checklists for your strategy based on causation, then you can consider the information box checked. You don't really need to do any more courses because you have the right confluences, you have the right information. That would be step one. Step two is now building a strategy with these said confluences. So let's say now you have a strategy that is embodying causative factors: liquidity cycle, the structure cycle, the daily cycle, lower time frame confirmations, time-based manipulations, and you're trying to build a strategy around that. Well, now we need to be more specific and we need to start to have rules in place. And as I always say, it's one of my favorite mantras, the most common thing I say all the time in every single video: a restricted trader is a profitable trader. And what that means is, with your confluences, with these now improved approaches to the market, we still need limitations, we still need rules. So we know volatility means entering the market when there is participants, when there's activity, when there's liquidity, when there's volume, meaning to say a London session or a New York session. Well, if we say when is the London and New York session, that still gives us a 12-hour window to trade. And that's not specific or restricted enough. Therefore, we need to find the most optimal times and know when these optimal, meaningful inducements happen. So we pair volatility with liquidity. So that's where I introduce time-based manipulation, a very strong way to be restricted based on probability, to have a statistical edge based on causation. For example, if you're looking for a time-based manipulation at London Open, that is a very strong restriction to have, a very positive expectancy and a very strong edge. Just like in the roulette wheel, if you have your two green options, exactly like that, you have now a statistical edge backed by something. So let's say that's one of your checkboxes for every single one of your trade models. Now you've added something that will definitely improve your edge compared to the gambler who's just hoping for the best. Now let's say you introduce lower time frame models. Let's say the break of structure, let's say the two-leg protocol, let's say the minor inducement displacement model. If we start to introduce these kind of entry types on top of our time-based manipulations, after we see inducement and displacement, then we have a very strong trio of time of day manipulation, meaning inducement, and lower time frame confirmation to confirm the reaction, linking cause and effect. If we start to build a strategy like this and we incorporate a supply and demand, market structure, daily cycle, build these things together, we will naturally have multiple trade types, and we can start to build these into categorized models. For example, Asia high liquidity, supply zone in a bearish market, London open, lower time frame break of structure, liquidity targets below of Asia low and a trend line, and introducing a smart money trap. That could be your trade type 1. And that would be a very strong trade type. Trade type 2 could be Asia low liquidity, two legs of bullish M15 structure in a bearish market, demand zone on M15, medium inducement, lower time frame confirmation after taking Asia low liquidity, and time of day. That would be another category of a trade type. So then you start to build out multiple trade types. Let's say you have 10 trade types, with each one having their associated scenarios and rules and checklists of requirements you need to enter the trade, with common denominators. For example, all of them should have time. All of them should have lower time frame entry confirmations. All of them should have inducements, but maybe certain ones need an entry type that's a break of structure, other ones need a two-leg protocol, other ones need an internal break of structure. So then when you start to combine all these things together, you need to start to see which ones are worth it for my strategy. So then you have to test each one. So you come up with ideas, you build them together, you give it very specific rules, and then you test them one by one. And that testing process, that stress testing process, is where you determine what is worth it for your trading plan and what is not worth it. So you will start to realize the data over 100 sample size, trade type 1 that I discussed, has an 80% win rate, but the trade frequency, it's pretty rare. But then you log that. Then you see another one, the trade frequency, it happens all the time, but the win rate is 40%. Then you log that. Then you'll have a set of data in front of you, which is going to be over a 100 trade sample size, so a large sample size. And you'll start to see the data for each one, how often it occurs, the average risk to reward, the average trade duration, the average trade frequency, how often it appears. And once you categorize all your trade models with all the trade confluences, with all the lower time frame models, and then the associated data of win rates, trade frequency, risk to reward, and so forth, then you start to look at all of this information, and then you build it together to pull your most statistically probable, the most profitable deployment plan. And you'll say, okay, these are my A+ setups. The ones that have a very high win rate, the ones that have a high trade frequency, and the ones that have a high risk to reward. These are my A+ setups. Then you have certain ones that are in reserve for when you're in a losing streak. That will be very high win rate, low trade frequency, high risk to reward. So you know that when you really need it, when you're really struggling, you just look for this golden setup, the highest risk to reward one you have, the highest win rate one you have, but it doesn't happen all the time. So it can't be your bread and butter trade type. That's your ace up the sleeve when you're in a losing streak, fall back on this A+ prime time setup. And then you have your other trades, that is, I'm in a winning period, I have 20% up in my account. I can start to introduce these 6 out of 10 setups, these counter trend setups, these re-entry setups. They are valid, they are tested, they have their data, but then you know when to deploy them. And then once you've collected all of that, that's when you are a professional trader, where you have causative factors to look at the market. Then you build them into trade models. Then you test them with the data of the trade models to see exactly what their win rate, trade frequency, risk reward, and so forth is. Then you build a deployment plan to know when, based on the situation you're in, if it's a new funded evaluation account, these are the trades I start with. If I'm in a losing period, these are the trade models I take. If I'm in a winning period and I have a 20% buffer, these are the trades I take. Therefore, it's trade models with context of deployment. And that's a step people forget too. So when we bring all of these things together, that's when you'll be the most professional trader you can be, because it's a proven edge with proven data, with a deployment plan and a context-based strategy. And the last piece of the puzzle to be a full professional trader is knowing how to track your performance to see if I take a loss, was it a valid loss or was it an emotion-based loss? Was it a wrong decision? Was it negligence or was it just part of the plan? You need to then also monitor your trading performance. You need to monitor your trading psychology. You need to use a platform like TradeZella to journal each one of your positions, to have daily reports of everything in your account, to know, am I following my plan and my predefined deployment strategy in a correct way? You can't keep that all in your head. You can't keep that on an Excel spreadsheet. You need that organized somewhere. And that's why I do use TradeZella. You've seen me use it in many videos for over a year now. And it's something that is essential because you need a proven edge, you need a deployment plan, you need the data, and then you need to somewhere to track it and say, am I following the data correctly? Am I performing correctly? Are my emotions in check? And then when you've completed that process, that's when you can truly say, I'm not a gambler, I am a professional trader.